need to borrow some money from the bank, better make sure the person you talk to is of the opposite sex. That's if you want to get a decent deal. Thorsten Beck, Professor of Banking and Finance here at Cass Business School, has been looking at this. Thorsten, what shape did this discrimination take?
We find that this discrimination takes the form of differentials in loan conditionality. So loan officers charge higher interest rates to borrowers of the other gender, and they also give shorter maturity loans. That is one way to look at it. Now, the other way we find out about this discrimination is that borrowers that are matched to a loan officer of the different gender for their first loans are significantly less likely to return for a second loan. And on average in this institution that we're talking about, borrowers come back with 65% likelihood for a second loan. If you are, as a borrower, matched to a loan officer of the other gender, you're 10% less likely, or 6 percentage points less likely to come back for a second loan. So it's both in terms of the conditionality of the first loan, but also maybe the general relationship between a loan officer and borrower is a different one according to the gender composition, and that makes borrowers less likely to come back for a second loan if they are originally matched to a loan officer of the other gender.
And could this really come down to unsaid sexual attraction?
Well, to put it into economist term, it's not taste-based, as we say. It is more based on the lack of experience. So all of the loan officers we're talking about, for them it's the first job after they graduate from university. So they start out as loan officers and have these borrowers from the same gender, the opposite gender, and we observe this discrimination really in the early parts of their career. For the first couple of loans where they have to screen applications, where they have to monitor loans, after a year, year and a half, this effect basically goes away and there's no difference anymore. So it's really about learning on the job of being, as a loan officer, as comfortable with borrowers from the same gender and from the opposite gender.
And your research had a pretty big sample size, and it was with a large institution.
Yes, it's a large microbank which is active across Albania in this case, with quite a large number of loan officers. Overall, we have several thousands of observations over a 6-7 year period. And the nice thing about this institution, since it's active across Albania, we can actually also compare the different settings where loan officers are active. So we can compare locations where there's more competition from other institutions, for example, and location where the institution is almost the only one. And there's also, again, a very interesting effect we find, that in more competitive environments, this discriminatory effect is a much smaller one. So basically, this is in line with what Gary Becker, a former Nobel Prize winner, for example, claimed, that competition makes the cost of discrimination go up and makes the likelihood of discrimination lower.
So any advice for policymakers and/or banks in this?
The lessons for banks is basically that in your human resource policies, you have to take into account this, the gender composition. Maybe, as one example, you could argue that these new loan officers should be matched with more experienced ones as they go on the job and start learning. For policymakers, I think, again, it shows the healthy effect that competition can have on avoiding this kind of discrimination, which ultimately everybody loses out from. The bank itself loses out from, the borrowers lose out from, society and economy at large loses out from. So competition, again, can bring in a healthy element to avoid this kind of discrimination.
And presumably your advice to borrowers is find a loan officer of the opposite sex.
Well, that would be the implication from our research. Of course, in our research, this is not possible because borrowers are matched to loan officers on almost like a random basis. As a borrower, you walk into a branch and the first loan officer available, that's the one that you get matched to, which of course is a condition to actually make causal statements from our research. Ultimately, of course, yes, that would be the implication, that would be the recommendation for the borrower. On a broader level, and this is not just about gender, it's more also about within insider and outsider groups. I mean, we are talking about gender. In other contexts, you could talk about different religious groups, you could talk about different ethnic groups. So there is a lot of evidence that it really matters with whom we are matched in terms of a partner in a transaction. Somebody from the same group, same gender, same religion, or somebody from the outside group. And ultimately, in this context, it seems of a disadvantage.
Thorsten Beck, Thank you very much indeed.
Thank you.